So this is not a good time to be a rich person in a poor country. The finance minister in budget 2016 has taxed the rich quite substantially. So if you earn an income of a taxable income of more than 1 crore a year, you were already paying a surcharge of 12% on your tax up for this financial year. That rate has now gone up to 15% from the new financial year. In addition, the dreaded dividend distribution tax is back. This has been a tax which has really been spoken about in the capital markets, and it's a tax which is not liked very much by investors. But the finance minister has made dividend income over 10 lakh in a year taxable at a rate of 10%. This means that your portfolio will have to be between 3.5 to 4 crore rupees at an assumed dividend rate of between 3 to 4%. So those are the two big negatives in terms of direct taxation. There are other provisions in the budget. For instance, SUV cars will now pay a cess of 4%. Additionally, for people buying luxury cars of more than 10 lakh rupees, you will have to pay a 1% tax at the point of sale. And if you're using cash to buy your jewelry or any of the high-ticket goods, at the point of sale, they will make you pay a tax of 1%. And it seems that the finance minister is keen to get you into the tax net, because if you're paying that tax, it is reasonable to assume that they will get your details. So anybody who's out of the tax net and is using cash to make big ticket purchases, watch out. So that's as far as the rich go. Now, what has he got for the not so rich, for the other end of the spectrum? There is a rebate for incomes less than rupees 5 lakh, which used to be 2,000 rupees. That rebate has now been increased to 5,000 rupees. There is a section which has been under a lot of speculation because it's been stagnant for a long time. This is a section which gives the house rent allowance for people who are professionals who don't get an HRA because their income is consulting income. That has gone up from 24,000 rupees to 60,000 rupees. That's a deduction. And there's a distinct nudge in the budget towards the National Pension System, the NPS. A new scheme, which is a market-linked scheme, is the NPS. The significant announcement is that the EPF corpus starting from the next financial year, it is not retrospective, but all accumulation after next year will also be taxed will be tax-free only to the extent of 40%, 60% will be taxable. So this is good for the NPS, it's bad for the EPF, because in the NPS product, 80% of your corpus goes tax-free. Remember, 40% is tax-free, 40% you're advertising, which is tax-free at the time that you get it because you're putting it into an annuity and your income gets taxed. Whereas the EPF corpus, 60% gets taxable. We should expect a lot of pushback from the trade unions on this one. But as a first step, it's a great thing to bring parity into a good market-linked product away from we'll declare an interest every year product, which is the EPF.